In the world of finance, it's often a story of the established champions versus the hungry challengers. And today, we're diving deep into a really fascinating strategic battle right in the middle of India's financial sector. We've got a high-growth challenger, Capri Global, going head-to-head with its highly valued established peers. We're going to unpack the numbers, the strategies, and figure out what's really behind this big valuation gap. All right, so here's how we're going to break it all down. First, we'll tackle the valuation puzzle itself. Then we'll decode the profitability gap that's really driving it. After that, we'll look at their completely different capital strategies, try to figure out what the market is pricing in for each of them, and finally, we'll ask the big question: who's more resilient when the economic cycle turns? Okay, let's jump right into the main puzzle here. You've got Capri Global, a company that's putting up some seriously aggressive growth numbers, but its valuation on the market is lagging way behind its peers. So our first job is to see just how big that discount is, and then start digging into why. And wow, the price-to-book ratio tells a story right away. I mean, the difference is just stark. The big players, the industry leaders like Bajaj Finance and Cholamandalam, they're trading at more than double the multiple of Capri Global. So what that means is, for every single dollar of assets they have, the market's willing to pay over twice as much for the champions as it is for the challenger. The question is, why? And that really is the central question that's going to frame our whole analysis. I mean, Capri is aiming for 25 to 30% growth, year in and year out. So why on earth would the market give it such a deep discount compared to everyone else? Well, the answer isn't really about growth itself. It's about the quality and the source of its profits. So, to crack that valuation puzzle, we've got to pop the hood and take a look at the profit engine. See, the market doesn't just pay for any growth, it pays for profitable growth. And the number one metric for that, the one that really matters, is return on equity, or ROE. And right here, you can see the two completely different playbooks. The champions, they're mature, finely tuned machines. They're built to squeeze out maximum profit right now. Their models are proven. Capri, on the other hand, well, they're the challenger. They're in a totally different phase. They're pouring money and resources into expansion, building the scale they hope will lead to those big profits down the road. And this number is absolutely crucial. The big industry leaders, they consistently deliver a return on equity of around 19 to 20%. That's the benchmark. That's what high-quality, durable profitability looks like in the sector, and it's what earns them those premium price tags. Now compare that to Capri. Their ROE is currently sitting around 11.8%. And let's be clear, this isn't because the business is broken. No, this is a direct result of their strategy. They are deliberately investing heavily in new branches, in tech, in people, and that temporarily pushes down profitability, all in the name of long-term growth. They're trading today's ROE for tomorrow's scale. Okay, so that brings up the next obvious question, right? How do you actually fund such wildly different strategies? A company that's focused on maximizing today's profit is going to manage its balance sheet very differently from a company that's gearing up for an all-out growth assault. And here you have it, straight from the horse's mouth. Capri recently made a huge strategic move, raising a massive amount of equity capital. And this wasn't just about grabbing more cash. No, this was about fundamentally changing the risk profile of their balance sheet to get ready for what's coming next. And this is the result, a leverage ratio of just 2.8 times. Now, in the financial world, that is incredibly low. But this isn't a defensive crouch. This is an offensive stance. This low leverage is Caprice's war chest. It gives them the firepower and, just as importantly, the safety margin to go out and aggressively expand their loan book. So their blueprint just becomes crystal clear. Step 1, raise a mountain of equity. Step 2, use that cash to de-risk the whole balance sheet by lowering your debt. And then, step 3, unleash that newly fortified balance sheet to fund an acceleration in growth. It's a very deliberate, very calculated plan. All right, so let's tie all of this back to the valuation. How is the market actually reading these two different game plans? You've got the champion's profit-first approach on one side and the challenger's growth-first gambit on the other.
This really sums it all up. When you buy into the champions, you are paying a premium for a long history of high, durable, predictable profits. The main risk you're taking on is that a big economic downturn just hits everybody. But when you invest in Capri, you're not paying for the past, you're paying for future potential. The primary risk isn't the economy, it's execution. Can they actually manage this explosive growth without tripping up?
Now, if we look at the price-to-earnings ratio, it adds another interesting layer. At 24 times earnings, Capri isn't actually trading at some massive discount to the rest of the sector. What this tells us is the market sees the growth and is pricing some of it in. But it's holding back that premium valuation. It's basically saying, okay, we see the growth story, but you need to prove you can turn it into higher, sustained profits before we pay up. And that brings us to the final, and maybe the most important test. How do these different strategies hold up under pressure? Let's stress test these models. Let's imagine two possible futures, one where the economy is booming and one where it really starts to weaken. Okay, so in a booming economy, Capri's whole strategy could pay off, big time. That low leverage balance sheet they built, it's like a coiled spring. They can rapidly expand their lending and just gobble up market share while their competitors might be more constrained. This could lead to some really outsized growth. But if things turn south, the whole story flips. In a weak economy, investors get nervous. They run from uncertainty and they flock to safety. Suddenly, the champion's proven, high-margin business models look like a safe harbor in a storm, while a high-growth story that's facing execution risk can start to look a lot less attractive.
And this really gets to the heart of the challenge for Capri. Let's be honest, growing this fast is just incredibly difficult to manage well. It demands almost flawless execution on every single front, from writing good, responsible loans to making sure you're collecting payments to keeping your costs under control. Any slip-up gets magnified at this speed, and it could really hurt the quality of their assets fast.
So what's the takeaway here for anyone watching this story play out? Well, it really comes down to this simple monitoring framework. You've got to ask, is their asset growth hitting that 25 to 30% target? And maybe more importantly, is their return on equity actually expanding toward that 16 to 18% goal? Are they keeping leverage and credit costs under control as they get bigger? And are their profit margins improving with scale? Answering these questions, well, that will tell you if Capri's big gambit, trading today's profit for tomorrow's dominance, is a winning move or a risk that just didn't pay off.